Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to J.P.Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. Overall, it was another gently positive week for the equity markets, led by European bourses and followed by other markets, China being the only one which was showing a negative return on the week. In the bond market, it was also very quiet. In the gilts market, we saw some of the shorter dated issues rise in price, in other words, implying a modest decline in yields, but longer dated where the effect was slightly the other way. So prices coming down, implying that the yields at the long end of the curve remain fairly firm. Gold retreated a little after its strong run, but there was little movement in the commodity markets. Turning to the investment trust sector, the Investment Trust Index, which comprises a large number of trusts that feature in the FTSE All-Share Index, was up just shy of 1.5%, a fraction ahead of the FTSE All-Share over the course of the week. There was a spate of announcements from investment trusts, some 25 reporting either full-year or interim results, most to the end of March, but some to the end of April. Standout names, perhaps, from those reporting annual results included Hansa, ticker HAN, which reported NAV total return of 25%. Ashoka WhiteOak Emerging Markets, the tiny newcomer to the market, reporting an NAV total return of 12% in its first 12-month period. And there were also positive results from Cordiant Digital Infrastructure, ticker CORD, and Montenaro UK Smaller Companies, NAV total return of 8%. Also reporting a couple of J.P.Morgan trusts, J.P.Morgan European Discovery and J.P.Morgan Japan Small Cap Growth and Income, both returning in the region of 5 to 7% NAV total return. Among those reporting a negative decline in the latest 12-month period were JLEN Environmental Assets and NextEnergy Solar Fund, both reporting NAV total return of minus 1%. And there were also interim results from the likes of Henderson Opportunities Trust, an impressive 18% gain there for the latest 6-month period, and BlackRock Income and Growth, NAV total return 14%. Overall, gainers in the investment trust universe outnumbered losers by around 2 to 1. So a positive week, with the best performance in share price terms coming from some traditional names that have been at the top of the leaderboard quite recently, including Polar Capital Technology, Allianz Technology, Manchester and London, all tech trusts. BlackRock World Mining also put in a performance. BH Macro and some of the Asian trusts also doing well. In a moment, I will be discussing some of the most recent announcements from the sector and where we are in terms of performance over the year and the outlook ahead as we come up to a general election, with two guests on the podcast. Peter Hewitt, manager of the CT Global Managed Portfolio Trust, which has 2 share classes, Income and Growth, and also with Andrew McHattie, editor of the Investment Trust newsletter, another regular contributor to our weekly offering on the podcast channel. This week, our investment trust profile for subscribers to the Moneymakers Circle features the Aurora Investment Trust, an interesting vehicle managed by Gary Channon of Phoenix Asset Management. A very different portfolio to every other trust in its sector, the UK equity sector. And we have profiles also coming up for Premier Miton Global Renewables, ticker PMGR, and Schroeder Asia Pacific, ticker STP. The 2 most recent profiles were BlackRock Smaller Companies, ticker BRSC, and Scottish Mortgage, ticker SMT. Our new weekly email now includes further information to round out the information resource that we're aiming to provide for subscribers. It summarizes the most significant movements in share price, NAV and discounts over the course of the past week. And also we have a table of the largest issuers and buybacks of shares. And we also have a list of the trusts making the most significant buybacks or issuance of shares. This week I had the chance to hold a three-way conversation with two regulars on the Moneymakers Investment Trust podcast. That is Peter Hewitt, the manager of the CT Managed Portfolio Trust, interesting vehicle with two separate share classes, a growth and income share class, and very popular with private investors. And also with Andrew McHattie, the editor of the Investment Trust newsletter, making one of his regular return appearances. So I'm going to start with you, Peter, actually, if I may. You attended a conference this week, at which there were various investment trust speakers. Tell us what the mood was there. This was in Edinburgh, not known a place for being that cheerful all the time, but what was the mood at this meeting this week?
Well, Jonathan, it was a Winterflood Investment Trust conference, and it was definitely more upbeat. Last year's conference was the exact opposite. Things were really quite downbeat in the outlook for trusts, discounts, where trusts getting new demand, a whole series of issues. This year, firstly, they had the biggest attendance for a long time. Over 100 people signed up, which was really quite good. So some great names speaking, and a couple of the standout presentations were from Laura Fall, who talked about Roland Law debenture, Henderson opportunities, all UK funds, UK equity funds, and Marcus Fairmudge, who I think, Jonathan, you've had on the podcast in the past, and he talked about property, TR property, the trust he runs, and the outlook for property. And they're both UK assets, mainly. TR property's got a lot in Europe as well, but they could see it coming through, it being better performance from the London Stock Exchange. Certainly UK equities, the last 3 or 4 months has been better. Still not conclusively being led by mid and small caps. Still the FTSE 100 is in front, but not by as much. Lots of mergers and takeovers, and a definite appreciation, I think, that values in the UK are very attractive. Profits and earnings estimates for the next year are not really being cut, and in selective cases may well be better than the market's expecting. And in the case of Marcus, property has gone through a big de-rating over the last couple of years. He was at pains to point out there's not been oversupply, particularly in the UK in some key sectors, and rental growth was happening. And all of that is when property's been out of favour. Discounts on property vehicles have really been quite wide. And so he sees quite a significant opportunity, I think, over the next couple of years. So those two, UK equities and property, which is two areas which really have been under the hammer for long enough, were definitely more positive and two of the best presentations in the conference.
So, Andrew, I wonder whether you picked up a sort of, we've talked about this before, a feeling of slightly improved sentiment. There is an argument that it won't take much at the margin in the form of demand coming back into the investment trust sector for it to start moving prices and discounts. Are you detecting more positive signs out there at the moment? It's been a pretty quiet week this week for investment trust shares. It's been a pretty quiet year, really, with some notable exceptions. But what's your feeling about the general mood now? Obviously, there's an election coming as well. We haven't talked about that. That might be overshadowing things a little bit. But what's your take on what Peter's just said?
Well, I was delighted to hear that positivity from Peter, because actually that's not been my experience at all. And I haven't picked up on anything like that. So it's good to hear. No, my feeling is there's still a great deal of negativity about, and I think that's expressed actually in the continuing wide discount for the sector as a whole, which seems to be stuck around 15%. It did show some signs of narrowing a couple of months ago, didn't it, Jonathan? But that's not followed through. And I think probably many people are still waiting for the interest rate cut to actually come through, and they're not prepared to invest until they see the whites of the eyes of that happening. And probably the election is also causing a little bit of reason to pause as well. And if you look overseas, of course, you have elevated valuations in the US and in some emerging markets like India. You have geopolitical concerns both in the UK and also across Europe and in France in particular. And so there's actually quite good reasons to be worried about quite a number of global economies and the outlook. So, no, I don't feel this positivity coming through at all. So I hope you're right, Peter, and that perhaps actually we will see this expressed in a bit more buying over the coming months.
I have to say, Andrew, you are spot on in terms of buying, because I think the narrative on UK equities and the stock market here has moved from being, towards the end of last year, it was all about companies leaving the London Stock Exchange seeking higher ratings elsewhere, to a bit of a focus on takeovers, mergers activity, which is continuing. We had Britvic today, and it's now big, medium, small companies. A lot of fund managers finding they've had a number of bids within their portfolios. So as we've moved into the spring, I think it's more been about highlighting the valuations in the UK and the fact that if you lock them in at this sort of stage, you're quite likely to do well in terms of performance. Now, that's fine me saying that, and I think actually professionals, in inverted commas, fund managers, are saying that. And so you notice gearing levels in trusts. I mean, Laura Fall was talking about Lowland, and I think it's got higher gearing. Quite a number of funds have got gearing in Mercantile, Temple Bar, across the board. It's yet to reach the buyers, in particular retail, and I am relatively confident it will happen. Maybe we need to get the other side of an election and interest rate cut, as you suggested. But I do feel that that could be the clincher in terms of discounts. I'll give you an example. I'm in the process of writing an annual report just now. The year end for the trust I run is the end of May. And in the income portfolio, the two best performers, up 30%, 27% respectively, are Temple Bar and Mercantile. Temple Bar, UK Equity Income Trust, Mercantile focuses on mid-caps. Now, it's interesting, the discount of Mercantile is the same as it was a year ago. And the discount of Temple Bar has not come in at all. And so then Mercantile is on a discount of about 12. That strikes me as being pretty decent value. Lowland, a discount of 13, and a good dividend yield, increasing the dividend. So I think we're past the point of worst negativity. And I feel that, in fact, in relative terms, the UK market's been one of the best performers the last sort of 3 months. Can it continue? I don't know. There's lots of things that could go wrong. But I certainly can see a base level having been reached. And at these sort of discounts, I think there's some very interesting value in the trust market.
One of the features of the behaviour of discounts this year has been that a lot of the alternatives are still in the doldrums. In particular, private equity has done well, but renewables and commercial property have not done well. But there is a lot of activity going on in the alternative sector, and that is bringing quite a lot of cash back into the shareholders' pockets in some of those cases. And I guess the question is, what are they going to be doing with that cash? I think you've highlighted that, Andrew, as an interesting issue. That money is going to go somewhere. The question is, where is it going to go? Is it going to go back into alternatives, do you think? Or is it actually going to go into equities? Or is it going to go back into cash and bonds and so on?
Well, it is an interesting question, isn't it? And I think initially, actually, the point about this cash coming back into portfolios now reminds us that corporate action takes quite a while to work through. And of course, the sector is very busy now working through all of its problems and reaching some degree of resolution. But actually, there were quite a lot of announcements about tender offers and partial share repurchases and return of capital to shareholders towards the start of the year, at the beginning of this year. And it's only now, actually, that those have been actioned and the money is actually coming back into people's stockbroking accounts. And in my account, I noticed, actually, I had about 4 last week. So that money is now coming back and is available for reinvestment. And when you're looking around and maybe making some difficult judgments about markets that are not universally positive, I think you are looking, of course, for both quality in terms of past performance records and the quality of managers, and you're also looking to buy in at the right price. So you are looking at those valuations and the discounts. And of course, if you're able to combine those two, then you've hit the golden jackpot. And I think there are some actually high quality trusts now on nice ratings. I'm thinking about trusts like 3i Infrastructure, which is on a 10.5 discount. And that trust has undoubtedly the best track record in that sector. You've got BlackRock Frontiers in the emerging markets realm, again on an 11.7 discount, which is quite attractive. Pershing Square Holdings for US exposure on a 21 discount. So you can, if you're lucky, combine that quality and the discount as well. But I think actually a lot of the money that's come out of alternatives may well go straight back into it because of those very wide discounts, over 30% you're seeing in those sectors you've mentioned, Jonathan. I think the three magic sectors actually of real estate, renewables and also private equity all still look very cheap.
Peter, I know you have a holding in 3i Infrastructure, for example, amongst those. Are you sharing Andrew's thoughts on that, or are you thinking that maybe the equities are looking better value than the alternatives? We know obviously interest rates haven't come down. The Bank of England passed on an interest rate cut this week, so did the Fed. So it's still hope deferred as far as interest rates are concerned. But you could make an argument that maybe the ship has sailed for a lot of the alternative asset sectors in the sense that we're not going back to the previous world we had after the global financial crisis when the whole kind of climate of investing changed. You couldn't get yield from a lot of places you could before. What are your thinking on that sort of issue?
I would agree with you, Jonathan. I think it will take some time, perhaps quite a long time, before the renewable sector, for example, comes back into favour the way it once was. I completely agree with Andrew regarding 3i Infrastructure. It's a company I've held for ages, and I think it's well run, and it's got almost growth characteristics, which is perhaps a bit different from some of the other core infrastructure stocks. And it comes through with the dividend growth has been good and decent capital return. And I mean, I think it's sort of 10, 11% per annum. You can't argue with that. And it gives you exposure to areas you wouldn't normally get. And so if I was a retail investor looking for one stock in the broader infrastructure space, you could do a lot worse than pick 3i Infrastructure. But I think more broadly, that's an area, I mean, because I'm writing this annual report, the two worst performers in the income portfolio were a renewables trust, TRIG, Renewables Infrastructure Group, huge trust, I think it's 2 billion or so. And the shares were down 12% total return. That's including a hefty dividend. So it just shows you the extent of the de-rating that's happened. And the other one was Impact Healthcare, which is a specialist property care homes company. It's now on a sort of 25 to 30 discount, but it has an 8.25% yield that's growing. That's quite something when you think about it. So all you could say now is it would be very difficult to sell at current rating. It's well run, it's not overgeared, all of that stuff. But for it to come back into fashion, back into investors' appetites, I think you probably have to see rates coming down. And also companies doing more in terms of selling assets, perhaps if they can, repurchasing shares. All these sorts of things can be helpful. And I think also it'd be interesting if we get some merger activity in the wider sort of renewables infrastructure space. We may not, but it would be helpful. A combination of all of that, and I think you begin to get on the front foot again in terms of share price performance.
Let's take one specific example that actually put out an announcement this week. Andrew, I think you noticed this is Aquila European Renewables Trust, which has been going through this process of strategic review and thinking about its options and talking to its shareholders and looking for some conclusions. They came out with a statement this week. Perhaps you could remind us what was said. But against the sort of background of wondering whether actually, well, in some of these cases, are the NAVs actually correct? In other words, are they perhaps overstated? Because if you can't realize the value for some of the things you own, which may be an issue for Aquila, then you have to put a question mark about the NAV, don't you?
That's an ongoing question for us all to wrestle with, I think, when we're looking at any NAVs of real asset trusts. And yes, this is an interesting one, Aquila European Renewables. It's a euro-denominated trust, possibly not owned by many retail investors, but I think it's an interesting case study here because actually back in its annual report for 2022, the board said it was considering different initiatives to try and narrow the very wide discount to asset value. It's looked at mergers, it's looked at sales of bits of its portfolio, and then it decided earlier this year that it really ought to put itself up for sale to see if it could sell itself as an entire business. But actually, what it has now said is that it has not attracted any buyers at a reasonable price that it could recommend. There was apparently one buyer who was interested in making a proposal, but it was too low. And so this is interesting because on the one hand, you have this actually 39% discount to NAV, apparently, And that, of course, gives you plenty of scope to find a middle ground between the share price and the asset value for a buyer to come in. But in the absence of a buyer, I think it does cast doubt on the validity of that asset value, because if you can't sell the assets for that price, then it's doubtful whether that's their true value, isn't it? And I think there are questions that arise from this, because now the trust is most likely, I feel, to go into a managed wind down. And I think managed wind downs are okay for certain types of trust. To my mind, they're fine actually for something like a debt fund where you can sell off your investments as they mature, or the same applies for private equity. But the difficulty, which actually Digital 9 infrastructure has illustrated very vividly, is that if you're a real asset trust like a renewables fund, of course, you're going to sell your best assets first because those are the ones where you're going to find buyers. And the problem with that is that you're left with the rump of poorer quality assets that you can't really sell. And so you're going into a cul-de-sac there. And I think that's very difficult for shareholders to come out with any decent value. So I think this is a very interesting case. And the absence of a buyer for this trust is a little bit worrying, I think, if you're trying to put faith in the full valuations of the NAVs across the rest of the sector.
I wonder what you think about that, Peter. I might just add it's not necessarily just in the renewables sector or the alternative sector. I mean, I used to be a director of an investment trust which we shut down because it was not viable. And I finally, 3 years later, got the final payment from the liquidator for a very small unquoted asset that they had. It's taken all that time to come through. It is a very lengthy process. I think that's something we all need to be aware of. But do you have any thoughts about the Aquila European, or the broader point about NAVs?
I don't know that particular trust in detail, so I'm not sure about their assets. But Andrew's right. Unless you can see some bids coming in for individual assets, now there have been sales with other companies of sort of individual wind farms, solar farms even, I think. And so they clearly have a value and there is a market, but it's not that widespread. I mean, it's not like you've got a portfolio of equities and you can sell AstraZeneca and sell Shell or whatever. It's just not like that. And so that's why you have to just have a bit of a question mark over the net asset value, and can they actually realize what the NAV is saying? But there have been examples of sales of assets. I think also there is quite a vibrant private market, not amongst listed companies, which possibly might help in some cases, but it's very much a horses for courses. And it could be Aquila European Renewables just has some not particularly attractive assets in some not particularly attractive jurisdictions. I'm not sure. But certainly if you can prove through sales of portions of your portfolio asset values, I think that does give quite a lot of confidence about the wider asset value of the trust and its prospects going forward, and also improves the balance sheet if we're able to sell an asset. So it's an important asset test.
I mean, it is interesting. I think we mentioned this before, the contrast between the property sector, where there's been a lot of activity, and some of the other alternative asset classes where there hasn't been. I mean, the dog that hasn't barked has been private equity coming in and taking things out, or other bidders and so on. So it is slightly concerning, I think you have to say. Let's talk about the other side of the coin. Let's talk about new issues and so on. Obviously, we haven't had any effectively for a couple of years, but we did have an abortive one recently, which was this Special Opportunities REIT, in which, as you said, TR Property actually was a small cornerstone investor. That didn't fly. What lessons do you take from that? Do you think that it's too early to be talking about more IPOs, or do you think it's the fact that it's close, but this wasn't particularly the right vehicle?
Well, I mean, that, Jonathan, was a question I asked the manager of TR Properties at the conference I was at. And it's actually quite interesting. There was a family office along with TR Props, some other funds from Columbia Threadneedle, and one or two other investors. And I'm going to say totaling something like 125 million. So that's quite a decent sized cornerstone. Now they set a minimum level of 250 and didn't reach it. So what we don't know is, did they get to 247 and narrowly fail, or did they hardly raise anything and it was miles off? I don't know. And I also think the people potentially managing Special Opportunities, which Simon Lee and his team who ran LXI, are very good property managers, quite astute. And I think And Marcus was making this point to me. It's the classic. Now is a great time to have money to invest in property. It does appear that there wasn't massive overbuilding. The work from home is gradually reversing. Rental growth is appearing in quite a number of areas, even in certain office, not Canary Wharf, but probably the West End of London. So all of that is a bit more positive. But this is when you can't raise money because either the market is just closed or there's lots of other trusts at big discounts that investors would prefer to. Why should I buy your trust when this new trust, or I've got here's one here that's on a 20 or 30 discount. And so I think we are still some way from IPOs happening. And I don't know whether as Special Opportunities was launched, say in the autumn, it would succeed, or actually whether it's further out than that. I'm not sure. But although I was I don't want you to think I was being overly bullish, what I was saying earlier, I do think things have bottomed regarding sentiment. But in terms of positive flows from investors who are keen to invest in a new trust with properly sensible management, a good strategy, we are still some way from that. And we may never get there. I don't know. But I do feel we will. I mean, my own feeling is maybe later this year, possibly into next, but clearly not now. And that was an acid test. And Special Opportunities didn't pass.
What's your thinking on that one, Andrew?
Well, I was disappointed not to see this issue proceed because, rather as Peter has just described, I thought the argument behind it was quite strong. But that said, my advice to my subscribers was not to buy it at the IPO. And so I wasn't prepared to back it, partly because I didn't want to be paying 100 pence for 98 pence worth of assets, thereby paying a premium rating to buy into something which was unproven. When, again, as Peter was saying, there are plenty of actually quite good quality property trusts with track records we can verify that are trading on 25, 30% discounts. And it's possible that Special Opportunities REIT with its blank slate would have a better starting point, but they've got a lot of ground to make up if there's a 25 to 30 discount involved rather than paying a premium. And I do wonder, actually, given that the door is rather firmly shut and really needs to be barged open for an IPO to succeed, I wonder whether actually the terms need to be rather better than these standardised terms we're being offered. I think it's wrong, really, that investors are being asked to pay a premium at launch. And I think back to the 1990s, which was a very successful period for IPOs in the sector, where, of course, warrants and subscription shares were very widely used to plug this discount gap and to overcome the initial costs of issue. And whilst I recognise there's really no appetite in the market for those instruments to return, I think perhaps managers and advisors need to think about being paid in a different way and perhaps deferring their compensation so that investors are not being asked to pay this premium up front.
Well, that was something that was suggested last year, I think, by a number of people. Of course, you're asking to take away the promoters and the brokers' lunch, as it were, something they got used to, and they're not a bit short of income at the moment anyway. So they may be asking a lot. But do you think that idea's got any legs, Peter?
Well, it could have. I mean, the likes of warrants and subscription shares do complicate the overall package that's being on offer. And the tradability of them and liquidity of them, question marks there. But it does actually go some way to addressing what Andrew was saying as a potential negative, is that you're paying 100 pence for 98p of assets. And if you can make the 98, even 98.5 or 99, all of that helps a bit. And I mean, I think you can do lots of things. For example, you could be charging fees on market cap rather than assets. Or in the case of property companies, you can have them being internally managed so that there's really less of an incentive just to simply grow the assets and focus actually on shareholder returns. And both of these may have mileage, and we could see them being adopted. But I think it still needs a far more positive investor sentiment towards investing into trusts. And in that case, I'm not just talking about property or renewables, I mean, across the board. And I don't think we're there yet, And I think the key bellwether is flows in UK vehicles, and that's still quite negative. And I mean, actually, give you an example, Jonathan, as you know, the managed portfolio trust has a growth share and an income share. And actually, the growth share has performed quite materially better than the income share in the last year. It doesn't really have the alternatives, which have not helped the income share, which are there for dividends. But I have been buying in shares quite regularly, growth shares. We buy in on a discount of just 3%. So I've been buying in shares, whereas with income, I've been issuing shares. And in fact, there's been twice on the same day, I've been buying in growth shares and issuing income shares, which must be a bit of a record. But what that tells you is where the sentiment is. And certainly they like a 6% dividend yield that's growing, even though the overall performance was quite a bit short of the growth shares. So actually, funnily enough, that's quite a good yardstick. And if you come on to me in a few months' time and ask me that, and I say, oh, well, actually, Jonathan, we're not buying in growth shares now, and we're still issuing income shares, maybe that's quite a good bellwether.
It's a go figure on that one, I think. Yes, absolutely. But against this, of course, one has to say also, if you look back to the start of the year, when we talked about the outlook for the year, and then we said what's going to do well, what isn't going to do well, sure enough, what's happened is at the top of the performance tables, we've got Manchester and London, Alliance Technology, Polar Capital Technology, 3i, and Indian trusts. Basically, that is growth and its momentum, and it's a very difficult trend to bet against. But, look, you'll think that obviously that trend is going to come to an end quite soon, and when it does come, it could be quite dramatic. But that's where the money's been.
You are right. And actually, in the growth portfolio, top three performers, Polar Cap Tech, Alliance Technology, and Scottish Mortgage. Yeah. Up 35, 35, and 33. So that's clearly what's been happening. But remember what I said in the income portfolio, Temple Bar, Mercantile, you're getting some decent performance from some of the UK trusts, and it's kind of happening on the quiet. It's been mainly in this calendar year, not the second half of last year, and it's been more recent. I mean, I'm looking at the evidence of how Europe's performed, Japan, even the US, and actually, well, the last 3 months or so, the UK is delivering. Now, it needs a heck of a lot more evidence there, but at least it's not the relentless underperformance. And of course, when I was talking about some of the technology stuff there, and good old Scottish Mortgage, and my word, it's a bellwether trust. It's the biggest trust, its discount has tightened in. It's done all the right things. It's buying back a lot of stock. But one of its biggest holding is Nvidia. So what do you do? I mean, all three of us know there's going to be a week, a month, a quarter ahead of us when there'll be quite a pullback in some of these big tech stocks. But at the same time, you also know probably in the medium term, they will deliver some quite interesting returns. So it's a tricky one, but I'm holding to my guns. I think some of the UK equity vehicles are beginning to deliver, and they still are at quite wide discounts, which I just think spells opportunity.
Well, I'll ask you, Andrew, for your thoughts on that in just a second. I mean, I just wonder, you mentioned the election earlier on. There's been a lot of publicity about the lack of pension fund investment in the UK market. Down to 4% or something from what it used to be, much, much more. Particularly back in the 90s, investment trusts were still owned by pension funds. But it's kind of become almost commonplace for institutions to look overseas to manage their portfolios. It's going to take something to kick them back into the UK. Value itself is not enough, is it? I don't think. Liquidity is important and so on. But there is something the governments could do, and I'd be interested whether you think that the incoming Labour government, assuming that's what we're going to get, is going to be able to do anything materially to help that. Start with you, Andrew, if I may.
Yes, I keep reading, actually, some interesting articles about the Labour government's tax policies and how, because they've ruled out raising taxes on so many of the major methods normally used, but they clearly want to start spending more money, they seem to be hanging their hat on future growth and finding ways of boosting domestic growth, which would be a wonderful thing. And of course, at the moment, that's utterly nebulous and we have no idea how they're going to go about that. But it would be nice to think that they might put in place some structures to help enterprise in this country and to push it ahead and to encourage a brighter future for us all. But it's very hard to know at this point because it's just in the nature of election manifestos that they're extremely woolly and devoid of any detail. And I think because the Labour Party has such a big lead, it's really trying to avoid saying very much at all. The main issue for them, I think, is trying to avoid putting any feet in any mouth at this point. So they're not going to say too much, I wouldn't imagine.
Well, there's other things they could do. I mean, certainly as far as investment trusts are concerned, we'd love to see them do something about stamp duty and cost disclosure and all these things, but they're likely to be high on their list of priorities, you would think. And it may be that they do some other things which are not so helpful. A lot of people talking about capital gains tax and so on being a potential risk. Peter, I won't ask you to tell us the outcome of the election. Well, you can have a forecast if you like, or who you'll be backing. But do you think you're approaching this with equanimity or with some element of concern?
Well, it's not really my job, what my views one way or the other. What we crave, I think, is stability. And I think we are probably going to get that, because it looks like there'll be quite a sizable Labour majority. And I think, actually, that's all priced into the market now. What would be a shock, I suppose, would be it actually not being quite as big a majority for Labour. But I do think that we do have to just watch it. And Andrew's right to highlight there are certain elements of tax which are unclear. And actually, I think back to, if you can recall, Jonathan, obviously way before my time, but when Tony Blair got into power in 1997, and there were certain similarities to just now. You know, you had a long spell of Conservative governments that was becoming a bit fractious, and they got ousted. And early on, I mean, Gordon Brown, the then Chancellor, gave independence to the Bank of England, which was a huge tick in the box. But if you also remember, he removed the tax credit on holding UK equities for pension funds. And actually, that was kind of a slow burn negative, and probably was the start of the reducing exposure of UK-based pension funds to UK equities. Now, there's a lot of other things then happened once we got into the noughties, the financial crash, and obviously Brexit. By then, actually, I think holdings were pretty low in the UK, and Brexit was more global investors exiting the UK. So we could do with not anything like that. And if there was something more positive, I mean, the removal of stamp duty might be, but that's just not going to happen because they're so strapped with the financial situation for government. So I think actually, if we just got what Rachel Reeves, the Shadow Chancellor, is saying, you know, certainly for the first 2 or 3 years of a Labour government, they're going to take on board what the Conservatives' constraints have been regarding debt and tax and the likes. That might be enough just to encourage people to say, well, have a look at the UK, because you've still got some pretty decent companies here, regardless of that. And I suppose the other side of the coin also is, if you did get a bit of a downturn in the US market, and particularly the big tech stocks, so that people decided, right, we're going to reduce our exposure there, I think you could find some coming to the UK under that scenario.
Well, here we are at this interesting juncture in the markets and in the investment trust sector in particular. So I think we should finish just by giving us some thoughts. I mean, I'd be interested in you telling us, Peter, what else you've been buying or selling in the last few weeks, just out of interest, or whether you made most of those moves in the autumn last year when the cycle seemed to turn. And I'll put the same point to you, Andrew, as well. But let's start off with you, Peter.
Well, there's a couple I've bought. I bought the J.P.Morgan UK Small Cap Growth and Income Trust, and I've actually got that in both my income and growth portfolios. There's only 2 or 3 stocks there, because I think Georgina Britton, the manager, is experienced manager, got a good record, quite volatile, but a good record. And I think there's a lot of interest, or I think a lot of potential in UK mid and small cap trusts. I've also got a position in Pershing Square a few months back, and that's US equities. That's Bill Ackman, the well-known hedge fund manager, and this is his listed vehicle. And the main sale, Jonathan, which I know personally you identified with quite closely, was a trust called Hypnosis Trust, which was one of your favourites. And so I've just decided to exit that, just about clearing what I put in. But it's interesting. So I've got 3 themes for the next year. The first one, I think we've discussed, UK equity trusts, which I think do offer some potential. The discounts they're on and the valuations that they are investing into. I think private equity trusts, still extremely good value, and some decent quality portfolios that I hope to see some NAV growth, as well as a closing of the discount. And lastly, is just to say that I would stick with what I call secular growth trusts. Polarcat Tech, Allianz Technology, Scottish Mortgage, and actually also some biotech trusts, which I think are beginning to spark into life there.
And what about you, Andrew? You say you've got this cash coming back in. What are you going to be doing with it? You talked about what you might do with it. What do you think you're going to be doing with it?
Yes, I mean, same as Peter, I had money coming back from Hypnosis Songs Fund, which I decided to sell in the market, and also quite a lot of cash coming back from tenders and share repurchases now. So I do have some money to reinvest. And yes, I'm adopting something of a barbell approach, actually, in that I want some income, and I do think there's some very attractive yields available across the sector. And I don't think you need to be too modest about your aims here. You don't have to be looking for 5 or 6% when you can get 7, 8 or 9. So actually, I think there's some very good quality trusts with good yields. And one that Peter mentioned earlier, Impact Healthcare REIT, is already in my portfolio, but I might buy some more of those. And I think there are good opportunities actually in real estate at this point in the market cycle, and also in renewables for income. But I also want some equity exposure. I think it's very important, actually, not to get too focused on the narrative in this sector, because, of course, these alternative asset trusts are generating all of the news the whole time. And actually, a nice, quiet equity trust that's doing its job and not generating any news can be an even better place to put your money sometimes. I do think, actually, that there's still some value to be had in the growth sector. I will be looking, I think, to buy even more RTW biotech opportunities, which I really like, actually. I think that's a tremendously well-managed trust that's been actually generating quite a lot of good news of late from its portfolio. I'm also going to put some more money into the private equity sector, where those discounts are coupled, actually, with some tremendous track records. And just for my own interest and entertainment, I was looking back at the 10-year track records of investment trusts. And if you rank those, HarbourVest Global Private Equity is on page 1 of the returns over 10 years. And yet this is a trust that you can buy on a 37.5% discount, which just strikes me as ridiculous. I think it's an absurd valuation, and I would happily take that, actually, while the market is offering it to me. And I think there's a lot of good value in those sectors, actually. So on the one hand, I feel as though perhaps I shouldn't be rushing to put all of the money back into the market at once, and maybe over the coming weeks, actually, a market reversal might give me a better entry point. I'm nevertheless still finding plenty of attractive buying opportunities in this sector.
That's good to know. And on a positive note on which to end this particular podcast. So my thanks to both of you, to Peter Hewitt, the manager of the CT Global Managed Portfolio, with its 2 share classes, income and growth, and to Andrew McHattie, the editor of the Investment Trust newsletter. More from us next week, when we will be putting out our only pre-election electoral podcast, featuring 3 distinguished individuals, and none of them aligned to any political party, or at least no longer aligned to any political party, and I think you'll find plenty of interest there, so do please look out for that.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited, and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note, these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.